Hello everyone, welcome. Today let's understand the Indian stock market in a very simple way. Think of the market as a giant shopping mall with thousands of shops, which are the listed companies. It's impossible to check every shop to know if the mall is busy or empty. Instead, we look at how the biggest and most popular shops are doing. In the stock market, these big shops are grouped into something called an index. An index gives us a quick snapshot of the overall market's health. It tells us if, on average, the prices of major stocks are going up or down. The two most famous indices in India are Sensex and Nifty 50. Sensex, which stands for Sensitivity Index, tracks the performance of the 30 largest and most actively traded companies on the Bombay Stock Exchange, or BSE. Similarly, Nifty 50 tracks the 50 largest companies on the National Stock Exchange, or NSE. When you hear news anchors say, the market is up today, they usually mean that the value of Sensex or Nifty has increased. These indices are like the pulse of our economy, reflecting the collective mood of investors. But we also have more specific indices that focus on particular sectors. Think of them as checking how a specific section of the shopping mall, like the electronics or food court, is doing. Two very important ones are Bank Nifty and FINIFTY. Bank Nifty tracks the performance of the top banking stocks. Since banks are the backbone of the economy, the health of Bank Nifty tells us a lot about the country's financial stability. FINIFTY, or the Nifty Financial Services Index, is even broader. It includes banks, insurance companies, housing finance companies, and other financial institutions. So, to summarize, these four indices are our guides. Sensex and Nifty give us a broad overview of the entire market. Bank Nifty and FINIFTY give us a closer look at the very important financial sector. By tracking these four, we can get a really good idea of where the market is headed on any given day. They are the first thing any investor, whether a beginner or an expert, looks at in the morning to understand the market's mood. It is our starting point for making informed decisions. Now that we know what these indices are, let's talk about the trend for today, July 14th, 2025. The trend simply tells us the general direction in which the market is moving. Is it going up, down, or sideways? Based on recent activity and global cues, the overall sentiment appears to be bearish, which is just a market term for negative. This means that for today, we might see more sellers than buyers, which could push the prices down. A bearish trend is often called a downtrend. It feels like a cloudy day where you expect some rain. Let's look at each index. For Sensex and Nifty 50, the broader market indices, the negative trend seems to be holding. This could be due to several factors, like international market news or concerns about company earnings. When these major indices are in a downtrend, it suggests that a wide range of top companies are facing selling pressure. Investors might be feeling cautious and choosing to sell their shares to book profits or to avoid potential losses. This creates a cycle where selling leads to lower prices, which can cause more selling. The story is quite similar for our financial indices, Bank Nifty and FINIFTY. These sector-specific indices are also showing signs of weakness and are expected to follow a negative or bearish trend today. Since these indices are made up of banking and financial stocks, any negative news about interest rates or economic growth can impact them heavily. A downtrend in Bank Nifty and FINIFTY suggests that investors are worried about the profitability and health of the financial sector at this moment. This is important because a weak financial sector can pull the entire market down with it. So, what does a bearish trend mean for you as a beginner? It means you need to be extra careful. It's like driving on a slippery road. You need to be more alert. In a negative market, the general expectation is that prices will fall. This doesn't mean every single stock will go down, but the overall direction is downwards. Understanding this trend is the first step in planning your strategy for the day. It helps you decide whether it's a good day to buy, sell, or simply watch from the sidelines. To navigate a bearish market, we need to understand two very important concepts: support and resistance. Think of these as invisible floors and ceilings for the stock index prices. Support is a price level where a downtrend is expected to pause due to a concentration of demand or buying interest. It's like a floor that the price has difficulty breaking below. Resistance is the opposite. It's a price level where an uptrend might pause or reverse. It acts like a ceiling that the price struggles to break above because of selling interest. For today, let's look at the key levels for our indices. For Nifty 50, the key support level is around 23,200. This means if Nifty starts falling, it might find some buying interest and bounce back up from this level. The resistance, or the ceiling, is at 23,500. If Nifty tries to go up, it might face selling pressure here. For Sensex, the support is at 76,300 and the resistance is at 77,000. These levels act as important markers for traders during the day. Now, let's check the levels for our financial indices. For Bank Nifty, the critical support level to watch is 49,500. This is the floor where buyers might step in. The resistance is at 50,200, which will be a tough ceiling to break today. For FINIFTY, the support level is around 22,100 and the resistance is at 22,450. Knowing these levels is like having a map. It helps you identify potential turning points in the market. If an index breaks below its support, it's a strong bearish signal. If it breaks above its resistance, it could be a sign of a trend reversal. Why are these levels so important? They help you set your expectations and manage your risk. For example, if you see Nifty approaching its support level of 23,200, you know that this is a crucial point. You can watch to see if it holds or breaks. Traders use these levels to decide where to enter or exit a trade and where to place their stop-loss orders to limit potential losses. They are not guaranteed, but they are very useful reference points based on past price action. With a bearish trend expected, let's discuss how investors can act. In the market, you can make money when prices go up or when they go down. When you expect the price to go up, you take a long position, which simply means you buy a stock or index fund, hoping to sell it later at a higher price. This is what most new investors are familiar with. For example, if you buy Nifty at 23,300 hoping it will rise to 23,500, you have gone long. However, in a bearish market, some traders use a strategy called going short or short selling. This means you sell a stock first and buy it back later. How can you sell something you don't own? Your broker lends you the shares to sell. You do this when you expect the price to fall. For instance, if you short Nifty at 23,400, you are betting it will go down. If it falls to 23,200, you can buy it back, return the shares to the broker, and the difference is your profit. This is a more advanced strategy and carries higher risk, so beginners should be very careful. Regardless of whether you go long or short, managing risk is the most important thing. This is where a stop loss comes in. A stop loss is an order you place with your broker to sell a security when it reaches a certain price. It's your safety net. For example, if you buy Nifty at 23,300, you might set a stop loss at 23,250. If the price falls to that level, your position is automatically closed, limiting your loss to 50 points. It's a crucial tool to protect your capital, especially on a volatile day. Never trade without a stop loss. So, what should you watch for today? First, keep a close eye on the key support levels we discussed. Will Nifty hold above 23,200? Will Bank Nifty stay above 49,500? If these levels break, the downtrend could accelerate. Second, watch the opening. A gap down opening, which means opening lower than yesterday's close, would confirm the bearish sentiment. Finally, remember that predictions are just guides. The market can be unpredictable. For beginners, a bearish day might be a good day to just observe and learn, rather than taking big risks. Happy investing!